Hey everyone, welcome back to another episode. In this video we're diving into a trade entry method from ICT known as the unicorn model. This setup takes shape when a breaker block aligns with a newly formed fair value gap zone offering a high probability trading area. So in this video we'll break down what this strategy involves and how to properly apply it on your charts. We'll also look at related formations that contribute to strong confluence zones like this. If you're into advanced trading setups, entry models and keeping your trading plan tight, make sure to hit the like button and subscribe if it's your first time here. Catch you after the intro and disclaimer. So what exactly is the unicorn model? The unicorn model refers to a trade setup that merges a breaker block with a fair value gap that overlaps. Now, before we get into the specifics of how this model works, let me quickly break down both of these concepts. A breaker block is an invalidated order block that shifts into a newly formed supply or demand zone on the chart. From basic price action principles, we understand that when price breaches a support level, it frequently turns into resistance due to the way market participants respond to that zone. The same concept holds true for order blocks. The market can bypass an order block for multiple reasons, like a change in market structure, the asset being overbought or oversold, reaching a significant level on a higher time frame, and more. When a valid demand order block doesn't reject price and instead gets broken, it flips into a supply zone. This is known as a breaker block, and we then anticipate a price rejection from that zone. Similarly, fair value gaps are also treated as supply or demand areas. When a bearish FVG shows up on the chart, it signals a sell-side imbalance where sellers have heavily outweighed buyers, typically driven by institutional involvement. This results in a moment of market inefficiency, prompting price to revisit the FVG zone to fill that void and re-establish equilibrium. This gives traders a chance to short the market in line with bearish momentum, but only if there are still resting orders within the zone. That's when price tends to react to the area and continue in the same direction. Keep in mind, fair value gaps, FVGs, need to remain unmitigated. FVGs are valid for a single use only. We only highlight FVG zones that haven't been interacted with yet. If price enters an FVG zone for the first time, that's when we consider it a valid trading opportunity. Once price taps into it, it becomes mitigated and is no longer reliable for future setups. If you'd like to explore these concepts further, make sure to check out our previous video. Now let's get back to the unicorn model. As we stated earlier, in this setup we're looking for the breaker block to intersect with a fair value gap, forming a high probability trading zone. When price revisits this area, there's an increased likelihood it will function as a solid supply zone and drive the price downward. In this situation, we'll look to enter at the start of the zone, set our stop loss just above it, and aim for the next significant level in the direction of the move. The same logic holds true for bullish setups. For our first example, we'll examine the euro-dollar pair on the 5-minute chart. Focusing on the peak of the latest impulsive move, we identify a fair value gap zone. The candle that caused this gap is viewed as an order block, highlighting a demand area that might drive price upward. If the price pulls back to this order block zone, we generally anticipate a bounce to the upside, indicating a bullish continuation. But what if the price breaks through this zone without reacting? It converts the zone into a breaker block, changing its function. The bearish leg that moved through this demand zone also formed a fair value gap, confirming strong bearish pressure on their own. Both the bearish FVG and the breaker block are solid trading zones, but when they align, they generate a high confluence trading zone, turning it into a key area of interest due to its added weight. High confluence zones are areas where several price action signals come together, making them more dependable. These zones draw strong interest from traders since the alignment of signals often raises the probability of a notable market response. With many participants watching these regions, they become prime areas where traders plan and execute their strategies. Now for the entry, place your sell limit order at the beginning of this high confluence zone and set your stop loss just above it to guard against price swings for profit taking. Look for a favorable risk to reward setup like 1 to 2 or 1 to 3 depending on the key market structure points in front of the price to handle your trade better. You might move to break even by closing half your position once price hits a 1-to-1 target. That way, even if the price pulls back and tags your stop loss, you won't take a loss. Meanwhile, you can let the rest of the position ride in profit without added pressure since the trade is now risk-free. Another possible entry method is to wait for price to revisit the trading zone and observe for candlestick reversal signals, like a strong wick rejection. This method is especially effective when the zone covers a wide range, giving you the chance to enter at a more favorable price point. For this approach, place your stop loss above the trading zone and use the same exit strategies discussed before. By merging these techniques, you can maintain a balance between protection and potential gains and tackle the market with increased confidence. Next we'll analyze gold on the 15-minute chart. The market is in a solid downtrend and the latest impulsive wave has formed a distinct fair value gap reflecting strong bearish pressure. The order block found within this pullback zone presents a possible entry spot for sellers, but if the price moves above this region it might suggest a change in market direction and signal a potential reversal. Now observe how the market has created an overlapping breaker block and FVG zone. This combination forms a high confluence zone offering a strong setup for a reversal entry. Our plan remains simple: enter at the beginning of this high confluence zone and place your stop loss just below it to shield against sudden movements. For profit targets, look toward major levels in the market structure beyond the current price and aim for a solid risk to reward ratio. This configuration lets us trade with assurance using the synergy of several price action tools to boost precision. By following this method, we increase the chances of capturing quality trades during reversal phases while maintaining tight risk control. Since we highlighted this entry within a trend reversal setup, it's essential to stress the value of using multiple time frames and price action confluence to enhance results. This involves applying techniques like top-down analysis, spotting overall market direction, and factoring in higher timeframe supply and demand zones into your study. For instance, in the gold trade example, suppose the market has touched a higher timeframe demand area. If a setup like the unicorn model develops in that scenario, it gives added confirmation. The analysis from the higher time frame supports the lower time frame entry even if short-term charts display bearish behavior. The broader time frame could still reflect a bullish trend. In this situation, the long position matches the prevailing uptrend, greatly boosting the odds of reaching our target levels. However, here's an important reminder: regardless of how solid a trade setup appears or how many confirmations line up, never treat the outcome as certain. Trading revolves around forecasting moves using probabilities, yet the future is always uncertain. The core of technical analysis and price action is spotting recurring patterns shaped by consistent trader behavior. Beyond that, market direction is beyond our control. It's equally essential to keep your expectations realistic. A method with only a 40% success rate combined with a favorable risk-to-reward ratio like 1:2 while limiting each trade to just 3% of your capital can still generate strong returns over time. Winning every trade isn't necessary to be profitable in the long term, but having unrealistic goals can lead new traders to chase losses and burn through their capital. The secret is maintaining discipline, sticking to your system, and realizing that steady execution, not flawlessness, drives long-term gains. Now, merging several significant trading zones isn't unique to the unicorn model. Another powerful setup frequently spotted in charts is the combination of a fair value gap and a reversed fair value gap. But what exactly does that involve? You already know what fair value gaps are. These are price voids between the wicks of 3 consecutive candles showing strong buying or selling pressure, usually triggered by institutional activity. When price revisits these zones, there's often a higher chance of rejection as the market reacts. But what if the price breaks through instead of rejecting? This creates what's known as an inversed fair value gap and inversed FVG forms, when price ignores the original gap and breaks through it, flipping its role completely depending on the breakout direction. For example, if a bullish FVG is broken to the downside, it now acts as a supply zone, showing potential selling pressure. On the flip side, if a bearish FVG is broken to the upside, it turns into a demand zone, suggesting possible buying momentum. Here's the key: when a normal FVG and an inversed FVG overlap at the same price level, it forms a high confluence trading zone. These areas are powerful because they mix leftover institutional orders from the original gap with the new dynamic introduced by the breakout. Traders can use this overlap as a top-tier entry zone if it fits the overall market structure and bias. Now let's check out a real chart example. On the Euro-Dollar 15-minute chart, we're starting with a strong uptrend. Price makes a sharp move to the upside, forming a fair value gap and breaking above the previous market structure. This breakout signals strong buyer momentum, suggesting the uptrend might continue, but then momentum shifts. Price reverses aggressively, breaking below the previous low with force and forming a new bearish FVG. Now here's where it gets interesting. If you look closely, you'll see the initial bullish FVG overlaps with the new bearish one. This overlap forms a high-quality supply zone, an area where sellers are more likely to step in. When price retraces back into this zone, the probability of rejection increases, giving us a clean opportunity to enter a short trade in line with the current bearish momentum. Sometimes when 2 key zones overlap, they form a large trading area on the chart. The problem with a big zone is that entering at the very start and placing your stop loss below the entire zone, or worse, below a swing low, can lead to an excessively wide stop. This makes your risk-to-reward ratio weak, and in some cases you're risking more than you can realistically gain before the price even hits your target levels. So how do you fix this? It comes down to optimizing your entry. A smart method is to aim for the midpoint of the zone. This tightens your stop loss and improves your Our setup. The trade-off though is that you may miss the move entirely if the price reverses before reaching the mid-level, but over time tighter and smarter entries can lead to more consistent profitability. Another solid technique is using the Fibonacci retracement tool. Apply it to the impulsive move, from the swing low to swing high, or vice versa, and look for key correction levels like 61.8%, or any level that aligns with your trading strategy. When you combine these fib levels with overlapping trading zones, you get a much more precise entry area to work with. Alternatively, you can wait for confirmation before jumping in. For instance, a long wick rejection off the zone is a strong signal that the market respects that level. Once that rejection candle closes, that's your cue to enter with your stop loss just below the zone. This gives you a more calculated and lower risk entry. While all these techniques help refine your setup, the real edge comes from consistent backtesting and optimization. Every asset has its own flow and personality. What works great on gold might underperform on euro dollar. That's why tailoring your tools to each pair and backtesting like crazy is key. Price action is universal, but your strategy should be personalized. That wraps up this breakdown. Keep refining your edge, and stay consistent in the process. Thanks for watching. I hope you found value in these insights. If you did, smash that like button, drop a comment with your thoughts, and don't forget to subscribe for more sharp trading breakdowns. Thanks for watching, and I'll catch you in the next episode. Stay disciplined, stay profitable.